There's one phrase that strikes fear into every long-term investor: the lost decade. It's the idea that you could invest your hard-earned money and 10 years later have nothing to show for it. No gains, possibly even losses. Scary, right? Well, here's the unsettling part. It's actually happened before. I'm your host, Eli Freeman, and as always, let's look at the data. There are three major periods in U.S. stock market history where the S&P 500 delivered negative real returns. That's returns after inflation over a 10-year stretch. The first was the 1930s, which was during and after the Great Depression. Second was the 1970s, marked by stagflation and economic turmoil. In the most recent decades was the 2000s, which was bookended by the dot-com bust and the Great Recession. Let's walk through each one. The 1930s. This was a painful time for any stock market investor during and after the Great Depression started. One of my favorite books is called The Great Depression, A Diary. It's by Benjamin Roth, who is an attorney who details just how painful the Great Depression was on the individuals of that day. Banks were closing, you couldn't access your cash at the banks, and the stock market continually declined. Starting in 1970, the stock market delivered a negative real return over that decade, essentially flat when adjusted for inflation. And in the 2000s, from 2000 to 2009, the S&P 500 lost 9.1%, and that does not account for inflation. That decade included the dot-com crash in 2000 and the 2008 financial crisis. All of these periods, if you had invested in them at the beginning of the decade and held on to your investments without making any changes, you would have lost money after you take into account inflation. However, very few people in reality actually invest and never make any changes. Especially if someone is working, then they're probably or likely contributing to an investment account such as a 401k. Nick Maggiulli in his blog demonstrates this in his article. He showed if someone invested $833 a month for 120 months or $100,000 across 10 years, what would you average in real returns? And the numbers may surprise you. A perfect example of this is in the 2000s. He shows that if you invested from January 2000 to December 2009, you would have slightly outperformed the inflation amount and had a positive return, even though the market was down 9.1% before taking into account inflation. Although I don't think many investors' primary goal is to just keep up with inflation, it is helpful to know that investing regularly can greatly help or hedge your investments against downturns. So, what's going on here? Well, it's called dollar cost averaging, and it helps you accumulate more shares when prices are lower. During downturns, you're not just watching your portfolio fall. You're buying more ownership at cheaper prices. It's the opposite of market timing. It's market resilience, built automatically into your process. Nick looked at every 10-year period from 1920 to April 2025. Only 11% of those decades had negative real returns if you were to dollar cost average. That means 89% of the time, spreading your investments out monthly for a decade worked out in your favor, even through the worst markets that are in modern history. Although, I do not want to stop at that and note that there are very few investors that invest in hopes that they only beat inflation with their investments. However, if we are only looking at the worst periods in the market, it's not too bad when you think that in some of the worst periods in stock market history, you are still able to keep up with inflation by dollar cost averaging. So yes, markets are uncertain, and yes, lost decades have happened, but the data tells a different story. If you keep investing steadily through thick and thin, even the worst decades haven't been completely lost, but they have definitely been a painful ride along the 10-year period. If you found this helpful and want more data-driven insights to guide your investing decisions, hit that subscribe button and don't forget to turn on notifications so you don't miss the next episode.